Have you ever heard someone complain? Who's still thinking about getting rich at a time like this? The world is in crisis, everyone is struggling. But ironically, the people who say that are often the ones who complain the most. Why am I still poor? Why don't I have opportunities like others? Think about it. If the whole world is struggling, where exactly is the opportunity to break through? Do I have to become the next Elon Musk? Start a giant company like Amazon? No, I don't need to do those things. I just need to understand. Timing's something most poor people never pay attention to. There's a saying in the classic curricula of top US business schools, like Harvard and Stanford. After hearing it, you'll see things more clearly. In the past 100 years, the easiest year to make money was 1932. Sounds strange, right? But if you know that 1932 was the worst year of the Great Depression in US history, then that statement becomes an investment truth. When the entire country was in chaos, doctors, lawyers, engineers lined up begging on the streets. That was when the quick-witted became millionaires. Not because they were more talented, but because they understood that crises are when assets get redistributed. If you're ready, you can be the receiver, not the loser. That's why people say wealth doesn't last beyond 3 generations. Assets circulate. But that cycle doesn't happen randomly, it follows a pattern. After nearly 100 years, a similar opportunity is returning. Do you feel it? After the pandemic, inflation, war, and when the Federal Reserve started loosening monetary policy, what do you see? A new wave is forming, and the rich have long prepared. They're quietly accumulating pieces of land, sacks of food, blocks of gold, bitcoins. What about you? If you're watching this video, remember this might be the only time YouTube recommends this content to you. Once, then gone. You don't need to do anything huge right now. But if you feel what I'm about to share can change your financial future, don't just listen and forget. Subscribe to the channel, turn on notifications, and if you find it useful, save this video with a like. The journey starts here, starting with understanding why the rich get richer even during crises. 1932 was known as the bottom point of the US economy. Imagine then, just a few $100s could get you to Harvard to hire top personnel, recruit engineers from MIT to work for you, not because you were that talented, but because they had no better options. Unemployment was so high that having any job was a blessing. Even the smallest job was something people clung to. During a prolonged unemployment storm, if your company went bankrupt, no worries, people were willing to wait 6 months to a year to apply again because nobody else was hiring. What about rental prices? Some offices were rented out for free for 3 to 6 months. Just to fill empty space, landlords preferred having tenants rather than vacancy. Warehouses overflowed with unsold goods. Factories were ready to sell on credit or debt. As long as someone took the goods, business costs were cheaper than ever. Theoretically, this was the time when business costs were almost zero. So why didn't anyone get rich? Because the economy hadn't recovered. People were still fearful. Fear made them unwilling to invest or spend money. That's why 1932 wasn't just an economic bottom, but a starting point for those who dared to act. After that year, America gradually recovered. Those who dared to start businesses in that dark period later became financial and industrial tycoons. It wasn't luck, it was choosing the right timing. So what about now? Look back at the past 5 years, the world, frozen by the pandemic, production halted, inflation soaring, interest rates skyrocketing, wars, ongoing global anxiety, falling investments, people hoarding cash instead of spending. But do you start to sense something? Things are cooling down? Interest rates begin to fall. News talks about recovery hopes. Wars may end, prices stabilize, money flows back into financial markets. But here's the scary part. Everyone thinks the danger is over. But economic recession and financial crisis aren't the same. Financial crises can be controlled by pumping money like after 2008. But economic recessions are totally different. They come when people lose confidence, lose jobs, and dare not spend, and that can't be fixed by money. You can save banks, but you can't force people to spend. When everyone chooses to hold money, No one spends or invests, everything freezes. No matter how much money there is, the economy stands still. Those who truly understand don't sit idle. What are they doing? They start accumulating goods, buying real assets, owning long-term valuable things, land, gold, food, resources, no hype. No loud media, no campaigns, just silent deals. If you look closely, you see the rich preparing. Because they know if they wait until everything collapses, it will be too late to buy anything. Does the present feel like 1932? Everything seems stable, but it's just temporary. A new wave is coming, and not everyone is calm enough to accept it. If you think the opportunity is gone, you've forgotten history's biggest lesson. Wealth is not built after recovery. It's built in the middle of recession. You can watch or start acting like those who did in 1932. Before you think about getting rich during crises, understand clearly the difference between financial crisis and economic crisis. They sound similar but are as different as fire and water, each causing very different damage. Financial crisis happens when the monetary, credit, and banking systems collapse. Imagine everyone, government, businesses, individuals living on borrowed money. You borrow to buy a house, companies borrow to expand. Government borrows to spend. Everything revolves around one thing: the belief that debts will be repaid. But what if many can't repay? Banks start running out of cash, and it spreads to financial institutions. People rush to withdraw money. Companies go bankrupt en masse. People lose jobs. Houses are seized and sold cheaply. That's financial crisis, a domino chain reaction that, once one link falls, the whole system collapses. Lehman Brothers' 2008 bankruptcy is a classic example. One bank's fall caused a worldwide wave of failures. But the strange thing is, financial crises can still be solved. Governments can print money, pump liquidity, save banks. Theoretically, if enough money is pumped in quickly, the problem can be patched. That's why financial crises usually last 1 to 2 years. Economic crises, however, come from the core of production and consumption. When people stop buying, no demand remains. Pumping money doesn't revive the economy. Look at history in feudal times. People lived by agriculture, limited land, daily food needs. Whether good harvests or bad, food was still consumed. No one was unemployed growing rice or raising cattle. But with the industrial age, things changed. Machines produce hundreds of times faster than humans. Costs are cheaper, productivity higher. One day, production outpaced consumption. A factory could make 10,000 cars a month, but only 1,000 people could afford to buy. What about the remaining 9,000? Inventory piled up, prices dropped, factories lost money and closed, workers lost jobs, unemployed people had no money to spend. This cycle repeated as economic crisis, not from the financial system, but from the core of production and consumption. It cannot be cured by pumping money because the problem is not lack of money, but lack of confidence to spend. You see this happening today? Tech companies lay off massively. People don't dare spend. They have money but don't use it. House prices drop, car prices fall, but buyers remain cautious. Why? Because they fear tomorrow will be worse. That's the economic crisis taking shape. In times like this, there are two types of people: those swept away losing jobs, money, direction, and those prepared owning essential assets that protect them during storms, and waiting to buy everything at unprecedentedly low prices. Which group do you want to be? We're entering a period where money loses value. What keeps value is essentials: food, land, precious metals, peer-to-peer exchange systems. Financial crises can wipe out your bank accounts, but economic crises can wipe out your ability to earn money, which is far scarier. There's a big question few seek to answer. Why did America not only recover quickly from the Great Depression, but also become the world's top power? The answer lies in one man, John Maynard Keynes, an economist who spent his life studying economic crises, realized a simple but powerful truth: when people don't spend, the government must spend instead. So he proposed to President Roosevelt a never-before-seen plan. The government would issue bonds to borrow money from the public. and use that money to kickstart the economy. The government didn't just build bridges, roads, schools, hospitals, airports, but actively created millions of jobs. If you didn't know business, they'd teach you. If you lacked capital, they'd advance money for construction. In other words, the government became the biggest customer of the economy. This wasn't mere relief, it was injecting new life into society. Unemployment plummeted. Crime and social unrest disappeared. More importantly, when people had jobs and income, they began to spend again, restarting the economic cycle. Roosevelt's policy not only revived America, but laid the foundation for modern capitalism. He didn't stop there. Upon taking office, Roosevelt made a shocking decision to abolish the gold standard. Before that, each US dollar was backed by gold. People could exchange money for real gold at banks. After Roosevelt's decision, that ended. From then on, the dollar was just paper money.